It's all about time. 20 years since we last saw euro-dollar parity, 6 months of a ground war in Europe, and counting down less than 30 days to the next Fed decision. This is Bloomberg Wall Street Week. I'm David Weston. This week, contributors Larry Summers of Harvard on his reaction to Chair Jay Powell's Jackson Hole remarks.
Look, I think he did what he needed to do.
And former IBM CEO Sam Palmisano on how to make the Chips and Science Act live up to its name.
You need to get the bureaucracy out of the way.
This was a week to mark anniversaries and look forward to deadlines, starting with Dr. Anthony Fauci's decision to step away from his NIAID responsibilities after serving 7 presidents over 54 years.
I tried, as you know, my very best to have the facts and the science guide us.
A very different anniversary came with the euro falling below parity with the U.S. dollar for the first time in 20 years, driven in part by the looming energy crisis and prospects for the recession that it may cause, something Ian Shepherdson of Pantheon Macroeconomics thinks is already here.
Europe's in recession now already. I mean, that's pretty obvious now. We see that lasting for a while.
We also passed the 6-month anniversary of Russia's invasion of Ukraine, as Putin's forces struck a train station in the eastern part of the country on the 31st anniversary of Ukrainians' independence from Russia, a Russia that is trying to take it back. That's an irony not lost on Amanda Sloat of the National Security Council.
It's a sobering reminder that just as the Ukrainian people had to fight to defend themselves and get their independence 31 years ago, they are unfortunately in a similar position today.
But it was also a week for celebration, at least for those saddled with student loan debt, with President Biden fulfilling his promise to give them some relief.
I made a commitment that would provide student debt relief, and I'm honoring that commitment today. We will forgive $10,000 in outstanding federal student loans.
But for Global Wall Street, there was really only one story this week, despite all the commemoration, and it came from Jackson Hole, and it came from Chair Jay Powell, as markets eagerly sought answers to their questions about U.S. monetary policy, coming less than 3 weeks from when the FOMC meets again, and the chair stepped up to the podium and basically said, we'd all have to wait.
Our decision at this September meeting will depend on the totality of the incoming data and the evolving outlook.
But as much as the Fed says it will pay attention to the data, the markets got the message that they shouldn't expect any relief from tightening anytime soon, as the S&P 500 was down just over 4% for the week, and over 3 of that came on Friday alone in response to Chair Powell. The Nasdaq fared even worse, down 4.4%, and again, almost 4 of that came on Friday alone. The bond market was a bit more complicated, with the yield on the 10-year up to just over 3%, barely up for the week. But the yield on the 2-year reacted much more to the Fed news, ending the week at 3.4. That's up 16 basis points for the week. To help us understand what the markets are trying to tell us, we welcome now Peter Kraus. He's founder, chairman, and CEO of Aperture Investors, and Liz Ann Sonders, chief investment strategist for Charles Schwab. So, Liz Ann, give us your take on what happened here. If the markets were expecting more of the same, they sure didn't react that way.
Well, I think, the narrative around the basis for the rally that started in mid-June, some of it had to do with the peak in the 10-year at around 3.5%. But this narrative that was created around the notion of a Fed pivot, we never bought into that narrative. I think a pause is something we should talk about at some point, as did Powell today. But a pivot to aggressive rate cuts as early as the beginning of next year, that the only reason the Fed would have the green light to do that would be a significant deterioration in the labor market from here, and or a much more significant deterioration in the economy. And for now, we haven't seen that. So it wasn't a surprise to see him really forcefully push back against the idea of a pivot, that once they get to whatever the sort of final hike is, they're going to stay there for a while. And I think the market had trouble digesting that.
So, Peter, if you look at the markets, they haven't entirely given up on that cut next year. They backed off of it some after the Powell remarks, but not 100%. Were you surprised at the market reaction?
No, I wasn't. I was a little surprised with August's gains. I mean, it was really sort of a melt up. It sort of persistently was a risk on type of market. And as Liz Ann said, there really wasn't any reason to believe that Powell was going to somehow give some credence to the idea that the Fed was about to reduce rates in the next 6 months. So I think the market sort of just realized that it was rising at a level that was not sustainable given where interest rates are likely to go. And we haven't really seen enough economic weakness to signal that rates are going to modify. So the market reacted to that. And I suspect it may follow through with more of a reaction until we get into September and there's real volume and real players in the marketplace. Right now, we're still in a very, very thinly traded market.
Peter, if the Fed was trying to get out of the business of really affecting the markets, it's not succeeding very much. I mean, obviously, the central banks around the world really got involved a lot, starting with the great financial crisis. And some people thought they were trying to pull out of it, including with the balance sheet rundown. But right now, how much of this is just driven by the central banks themselves, Peter?
Well, we have not seen a return to fundamental investing. We're still in markets that are captivated by headline risks and headline commentary, whether it's the Fed or whether it's the Russia-Ukraine war or whether it's China's COVID policies. We're still being driven by headlines and not enough fundamental analysis. I suspect that we're going to come to a market where fundamental analysis will have much more of an impact on what investors actually invest in, but we're going to have to get to some level of the bottom here. And I don't think the market's quite there yet, but it's forming a bottom.
So Liz Ann, one of the things that Peter just mentioned actually was liquidity. To what extent is that playing a significant role right now in what we're seeing in the markets?
Well, there's the short-term impact simply of just light volumes by virtue of it being August. And I think Peter's right about that. But we've basically done a 180 in the liquidity environment with the Fed having gone in the past year from 0% interest rate policy, ballooning the balance sheet to $9 trillion, and now starting that process in reverse. Not to mention the fact that so much liquidity has moved away from the traditionally liquid markets into less liquid markets. And at a point in time, possibly where there is that need for more ample liquidity, I think that has the potential to be a future strain. I also think that Peter's absolutely right. This has been more macro driven, not fundamentally driven, certainly not the unbelievably low quality bias to where some of the speculative juices were running most hot in this rally from mid-June to mid-August. But we're also dealing with, I like, David, to sort of channel the old days on Wall Street Week. And my first 13 years in the business, starting in the mid-'80s, was working for the late, great Marty Zweig, who coined the phrase, "Don't fight the Fed." And I think Powell's underlying message today was, hey, don't fight us.
Yeah, that's really right. You were an important part of that Wall Street Week, I must say, back in the day. Let's pick up on one thing, and that's credit. Because we really haven't seen credit spreads blow out yet. Should we expect that coming?
So we did see a maybe not a blowout, because it depends on how you define that term, but we did see a pretty significant move up in spreads, and then they retreated a bit in conjunction with the rally in the equity market. But that contributed to a loosening in financial conditions, which maybe not as explicitly focused on today by Powell. That was another thing I think they needed to and are starting to push back on, is this loosening of financial conditions. And I know we had our conversation earlier today, and Peter has thoughts that I think we're not out of the woods, certainly from a credit environment. There's a lot of low quality zombie companies out there that probably are going to face some growing pressure.
Yeah, I mean, as Liz Ann points out, we have interest rates that are 2 times what they were 6 months ago. And while there may not be a maturity wall that we're facing, because many companies have been able to refinance in the last 18 months, that's not entirely true for the commercial real estate market, number one, and it's not true for every company. And so as we continue to see a slower economy and less revenues and more pressure on cash flow, I suspect that we will see some credit widening, and we will see some stress in the credit markets. And that hasn't really happened yet. And one other issue on liquidity, we talk about liquidity as it relates to the Fed. We also have to talk about liquidity as it relates to the actual trading markets that credit lives in. The trading markets that credit lives in have been very thin, very illiquid, and create significant gap risk. And that is going to continue. And I don't see that changing in any short period of time.
Listen, I wonder, does the rise of private credit contribute to some of the lack of liquidity, the thinness in the market, some of the opacity?
I think absolutely. I think we've taken for granted for much of the past 15 years or so in the aftermath of the global financial crisis with the Fed going to zero interest rates and starting multiple rounds of QE. And I think we've been in this environment where liquidity was so ample that we didn't worry about that. I think we're now entering a part of the cycle where we're going to find that we probably should have had a bit more of a cushion.
Okay, Ann Sonders and Peter Kraus will be staying with us as we turn to how investors might make some sense of this uncertain time. That's coming up next on Wall Street Week on Bloomberg.
It was a week when investor concerns tilted back to the possibility that the economy was not slowing fast enough to head off an increase this fall in inflation and interest rates. As a result, bond yields retreated to near their 1996 highs set in early July, and stocks took their first tumble in 6 weeks. The conventions couldn't seem to cheer anybody up for long.
That was Louis Rukeyser on Wall Street Week back in August of 1996. It was a presidential election year when the inflation he was concerned about was at 3% and a gallon of gas cost $1.63. And that, by the way, is in constant dollars. The number one song was the Macarena, which gave rise to a dance craze. And while the biggest movie was Tin Cup, the Kevin Costner star in it playing a washed-up golf pro. Still with us are Ann Sonders of Charles Schwab and Peter Kraus of Aperture Investors. So, Peter, I want to ask you to reminisce about 1996, but you said something earlier that I thought was interesting, that we might be getting to a point where maybe there's a return at some point to fundamentals in investing. Where do you see that happening? When do you see that happening? And what will that mean for investors?
Well, I do think that I said earlier that the market's trying to figure out a bottom. The bottoming process is not precise. It takes time. Investors have to sort of feel their way, if you will, in the dark at the bottom of the trough. But I think we're in that kind of mode. And once that really happens, then investors will start to think about, okay, what does the world look like going forward? And the argument is that growth is probably not going to be robust, broadly speaking, but investors will start to look for companies that have sustainable cash flow growth, sustainable business models, and opportunities for earnings to grow with some degree of confidence. And that's where they're going to start to invest. And that's when you're going to start to see the headlines recede and the fundamental investing come to the fore. When that is, that's a hard call. But the catalyst for that will be when the market starts to find a bottom. And that's when I think investors will move to the fundamental point of view.
So listen, help me with that. What does it mean to turn to the fundamentals? Does that mean sort of slow and steady wins the race when you don't have a lot of growth coming your way?
So I think in a growth-constrained environment, you do want to look for the types of factors that highlight if you have either that sustainable growth or in a declining earnings revisions environment like we're in right now for the broader market, the companies that are bucking that trend and have positive earnings revisions. I'd echo what Peter said about strong free cash flow yield in a rising rate environment, which we're clearly in right now, healthy balance sheets with lower debt, higher cash. There's going to be times, though, when you get to the point where there's a more definitive bottoming in economic activity. And I think in this cycle, that's probably only going to come when we start to see stability in housing. And I don't think we're there yet. I think we're still in the deterioration phase. Then there's an opportunity to go a little bit more cyclical and develop that leverage to a turn up in the economy. But in the near term, I'd stay focused on those kind of hybrid growth and value characteristics with kind of a quality wrapper around them. That's been our mantra for much of this year.
Peter, we heard from Jay Powell, the Fed Chair, this week that he really was intent on getting inflation down, but it looks like it's going to take a while to get that done. Are we looking at a higher inflation environment for the foreseeable future? And if so, what does that say about your investments?
Yeah, absolutely. I mean, I've been of the opinion, and I've not been right in terms of timing, but we've had 30 years of declining interest rates since Volcker and since the last time we had very high inflation. And by the way, if you recall in those time periods, those inflation rates, while they were high, were also pretty sticky. They didn't come down that fast. So the chance that we are going to go back to sort of a very benign inflation environment, or even a declining inflation environment where rates continue to bump along at the bottom and are not really much of an issue, I think is not in the frame. I think we're going to have inflation. I don't think it's going to be 5-6% or even 4%. I think it could easily be in the threes. I think there's going to be dispersion between regional growth rates between Europe, the United States, China, emerging markets. That's going to make central bank activity less coordinated, more dispersion between currencies. And I think that's a marketplace where investors will actually thrive, where active investors will actually thrive. And, some investors won't do well, but I think those smart investors who can be flexible in the kinds of factor rotations that Liz Ann was talking about, I think will actually do well here. But
so go ahead, Peter.
Yeah, I was just going to say, but I think it's wrong to conclude that we're in an environment where the Fed is going to go back to being the Fed put. The Fed is not going to do the Fed put. The Fed is going to increase interest rates, and they're not going to create the kind of liquidity that you've had for the last 14 years.
And David, I think there's a characteristic associated with what Peter is talking about, to the extent he's right, and I believe in this too, that we're now in the beginning of a more secular environment that has a higher kind of landing point for inflation. If you go back to basically the 60s, 70s, and 80s, it was an environment of a negative correlation between bond yields and stock prices, because typically when yields were rising, especially sharply in that environment, it was because of an inflation problem. It's sort of more of a toxic environment for the equity market. The era of the Great Moderation, you flipped that on its head, and you had a positive correlation, because yield pops during that era of Great Moderation, the 20 or so years preceding the pandemic, was because growth was picking up without that concern about inflation. That's a great backdrop for the equity market. So I think the tell will be if we're in a more sustainable period of that negative correlation between bond yields and stock prices. And I absolutely agree that taking more of an active approach, not just on the equity side, but on the fixed income side, is a way to navigate a very different environment than what most people are used to, at least looking at the past 20 years.
Lizanne, pick up on Peter's point about dispersion in currencies and nations. We've seen that certainly with geopolitical risk right now. Some of the other factors. Goodness knows Europe is in a very different position from the United States, which is in a very different position from China. What does that say when you're investing? How do you take advantage, or at least not get burned by that dispersion?
So I do think that we're in the beginning of a more volatile era. And I would say that not just in terms of asset markets, but more geopolitical volatility, more economic volatility, shorter cycles in terms of both the length of expansions, but the frequency of recessions. And one way to navigate that for investors is, first of all, go back to your disciplines around diversification and rebalancing. And what greater volatility affords you the opportunity to do is use volatility-based rebalancing or portfolio-based rebalancing. Let your portfolio tell you when it's time to, trim into strength, add into weakness. There's an opportunity these days to be much more diverse in terms of asset classes that even individual investors can have in their portfolio in a low-cost, very easy way versus the standard old-fashioned, our options are stocks, bonds, and cash. So I think there's a way that individual investors can take advantage of just a broader swath of offerings out there in order to boost that diversification.
So, Peter, help me with this, just what Lizanne just said. In that world where it's not just stocks and bonds and cash, are you looking at alternatives? Are you looking at real estate? Are you looking at going longer in duration? Where do you go that the other people are not?
Look, duration is going to be expensive for investors for the next, couple of years. At some point, duration will give you value. At least it'll give you coupon. But I think you need to look at your portfolio and assume that there is a 3 to 4% inflation rate over the time period you're going to hold an asset. And you have to decide that that asset will actually do well in that inflationary environment, or let's put it this way, in a more inflationary environment than kind of the benign world that we've been living in. That could, in fact, mean real estate. But real estate today is a very challenged asset class because COVID has had a huge behavioral impact on office properties and on how people use offices. So the adaptation of the office market to the COVID behavioral shifts and less than 5-day working and working from home and the flexibility that's come with that hasn't hit the bottom yet. And we haven't seen that stress work its way out. So real estate's going to be a tricky asset for the foreseeable future. And that's something that I think will be interesting to take advantage of.
So, Lizanne, briefly wrap this up for us. Give us a little hope for growth. Where would it come from?
So I think we may be shifting into an environment eventually, not in the very near term, of a more investment-driven economy and less a discretionary consumption-driven economy. And if that's correct, I think that's a more optimistic outlook longer term for the economy than just if we went back to that consumption model purely.
Yeah, and who knows? Maybe Congress is leading the way. They're doing a lot of investing these days, as far as I can tell. Very active Congress right now. Thank you so much to Peter Kraus of Aperture Investors and Ann Sonders of Charles Schwab. And coming up, we're going to take a look around the world and consider what is coming up next week on Global Wall Street as we go to 3 different locations all the way around the world for a preview. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. Falling PMIs in the week ahead are likely to show China's recovery being hit from all sides. Bloomberg Economics expects slower industrial profit may add to warning signs that have prompted new stimulus pledges from the government in recent days. In Japan, employment data will likely show a mixed picture, with summer travel boosting hiring in services, while slower export demand hits workers in the manufacturing sector. And skyrocketing inflation is likely to keep climbing in Pakistan and Sri Lanka. Now over to Tom Mackenzie in London. Tom?
Here in Europe, with energy prices hitting new highs, the focus switches back to Nord Stream 1. That's the pipeline, of course, that transports gas from Russia to the European markets. It is looking like there will be an unscheduled stoppage of that pipeline on Wednesday. The last time it was closed down, it reopened with reduced capacity. The fears this time is it may not reopen at all. And of course, those record energy prices are tying into the inflation picture. We're going to be getting CPI prints out from some of the biggest Eurozone economies next week. So we'll get an indication of just to what extent those gas prices are playing into already red hot inflation across the Eurozone. And here in the UK, we're counting down to the end of voting, the end of the ballot within the Conservative Party to choose the next British Prime Minister. Will it be the Foreign Secretary Liz Truss or the former Chancellor Rishi Sunak? Whoever it is will have to navigate and lead the country through what is shaping up to be increasingly a winter, it seems, of discontent.
Fresh off the heels of Jackson Hole, we've got even more Fed speak coming up stateside. The presidents of the Cleveland and Atlanta Fed are all due to speak on what comes next for the central bank. But the main event is Payrolls Friday. The jobs report is in the spotlight. How much unemployment is too much in the face of extremely high inflation? And does it even matter as economists call for an inevitable job-full recession? And a return to the fundamentals. At least in theory, we'll get earnings reports from Best Buy, Chewy, and Lululemon, to name a few. How do these companies fare in the spending slowdown and inventory buildup that's plaguing retailers? And it doesn't stop there. Business investments also in the limelight with results from Broadcom and CrowdStrike.
Thanks to Juliet Sally, Tom Mackenzie, and Kriti Gupta. Coming up, Congress has enacted a raft of legislation for investing in America. From infrastructure to semiconductors to green energy. What are the chances it will all work? We asked contributor Sam Palmisano, former IBM CEO. This is Wall Street Week on Bloomberg.
Call it the next space race, the push for public funding for semiconductors, starting with President Xi's program described by former U.S. Ambassador to China, Max Baucus.
They're hell-bent in pursuing their China 2025 plan, where China will focus on technologies of the future to enhance their economy.
And followed by Europe's own version, described by Margaret Vestager of the European Commission.
What I have been impressed with is that sort of the first important project of common European interest that we have on semiconductors. Here, about 2 billion of public support, crowded in 6.5 billion of private investment.
Now, the United States has its own version, the CHIPS and Science Act, just signed into law by President Biden.
The United States must lead the world in the production of these advanced chips. This law will do exactly that.
And as in Europe, Commerce Secretary Gina Ramonda predicts the public funds will prime the pump for much more to come from the private sector.
As big as $52 billion is, it is a drop in the bucket, a very big drop in the bucket towards what this economy needs.
All of which leaves us to focus on how fast the money can get out the government door, whether it will let loose the private sector, and whether it all will be spent wisely.
Go looking for really talented, experienced people in a wide range of ages who understand these technologies and get them on board, either as employees or advisors, to help guide the process of making these investments as high potential and productive as they can be.
And to help us understand this world of global competition in technology, and particularly the role governments might play in it, welcome now somebody who spent a good part of his career in the middle of that competition. He's Sam Palmisano, the former IBM CEO and chairman. Now he's the chairman of the Center for Global Enterprise. So welcome back. Great to have you on Wall Street Week, Sam. As I say, this is not the first time we've had governments involved in tech by any means. Going back to MIDI in Japan, DARPA, the Defense Department. What have we learned from that? What should we have learned from those experiences?
Well, David, I think it's a great analogy that you draw, and you seem to be a historian of our industry. I actually was living in Japan during the memory wars. I was living in Tokyo at the time, working in IBM Japan. Now, today things have changed, I mean, clearly, because it's not Japan who was part of the worldwide economic and governance systems. It's China. And China, as you know, is fast-growing economy, investing trillions of dollars in technology. They want to lead the West. They want to be the worldwide leader in semiconductors and microelectronics. And the majority of our capacity is Asia, and it's not exactly a stable part of the world. So it's quite different. So it's more than just government involvement and adding stimulus to get investment in these key critical areas. They have the geopolitics at play. So it's very complicated, much more so than it was in the past.
But it doesn't always work, does it? I mean, I think a lot of people think that the MIDI experiment over in Japan actually ultimately was not successful. Japan is not a dominant player in semiconductors today.
That's correct. I mean, I would argue that the execution by government then was very poor. I used to meet with MIDI, and they were stronger in electronics, and they still are strong in manufacturing electronics. But to fill in what was required from the industry's perspective, you also had to have software capability, and they were weak. So many times, I think the government doesn't understand what's required to actually not just invest, but to lead, and then the discipline that's required to execute these things with precision.
So, Sam, as you suggest, I mean, China really has changed the game, I think, in technology in all sorts of ways. And given its authoritarian aspect, which means it can do pretty much whatever it wants to do, as well as the massive amounts of money involved, does it make it almost essential that the United States, and for that matter, Europe also, some way step up to the bar?
I think it's key. Now, I know many of my colleagues in the private sector will find that that's strange for somebody that ran IBM to say those things. But this transition is very, very expensive. And I don't think you could have a company, regardless of how successful they are, Intel, AMD, ASML in Europe, et cetera, do this on their own. They're taking on a sovereign nation. And when you're taking on a sovereign nation, it's not like competing in your industry space. So there is a role for government. Now, the question is, what is the role for government? And I think we all know, we've all learned that government picking winners and losers, even if you're an authoritarian government like China who can act quickly, doesn't always work for lots of different reasons. But I think you need to have this partnership and not have the government pick and choose who the political winners or losers happen to be based upon votes per state and all the things that they consider beyond just what it takes to make this business successful and what it takes to lead in technology in the world.
So the lead in implementing this in the United States is going to be Gina Ramonda, the Secretary of Commerce. Give her a little advice. I mean, we've talked to her, and she says she wants to get that $53 billion out the door as soon as possible. What would you tell her to make sure that it goes to the right places in the right time?
Oh, that's an excellent question. I'd start with the fact that Having been involved in these types of programs in the past, the application process to get approval to proceed is extremely onerous and very complicated. And many times people just give up. There a lot of this went on in the electric modernization or digitization of the grids when I was working. And the government processes are so cumbersome, people just said it's not worth it, the heck with it, those kinds of things. In this case, it's permitting that's required and location that's required. Now, the good news in this, quite honestly, is the states are heavily involved, like Ohio, and the states are much better at getting these things done, in my opinion, than the federal government is. So that's just based on my experience. So that's the positive side of this thing. But you need to get the bureaucracy out of the way. It's the same thing they did with the vaccines. You got to get the bureaucracy out of the way so you can move very, very quickly. Now, the other piece of this, quite honestly, I advise her on is you have to look beyond just production capacity. I know that's the bill, that's where the money is, but the issue is more complex than just locating the fabricators.
If you look back in history, the U.S. government does not have an unblemished record when it comes to waste when you're putting a lot of money out in the marketplace, and yes, even fraud. How do you get the bureaucracy out of the way, but at the same time make sure the money's going to the right places and the right people and not being wasted, or for that matter, fraud isn't being conducted?
Well, quite honestly, David, I'd start by getting competent people involved. And what do I mean by that? There are people in this industry that know how to do these things. I mean, I'm not volunteering for work, don't misunderstand me. I'm really not. However, there are people. Engage the people who know how to get these things done. Government, for whatever sets of reasons, goes on their own. And that is a problem because in these very complicated areas, you need people who have done this before, who have the expertise, and you need to engage them. They're turning it over completely to the government agencies without a partnership of some kind with capable people, I think will be a mistake. I've argued this for years on the Obama Commission when it came to cybersecurity and the government network infrastructure. You need to get people involved that know how this stuff works. However, having said that, my experience is government in the U.S., clearly in the United States, is very hesitant to do that. I cannot explain why. I just know they're hesitant to use the private sector expertise.
Finally, Sam, to take a step back here a moment, we talked about China, we talked about some of the geopolitics involved in semiconductors. There are a larger set of issues now in geopolitics around the world. You don't need me to tell you whether it's Russia and Ukraine, whether it's Taiwan and China, whether it's Iran, everywhere you look. As a former CEO of a very large global company, how does it change how you make your investment decisions, what you're seeing geopolitically right now?
Well, I mean, David, quite honestly, it makes it much more complicated. I mean, if you think about it, there was a system before the world globally integrated called the hub and spoke. And by that, I mean, you maintain manufacturing, your R&D and IP in your domiciled headquarters locations, and you sold things into other countries. Today, as you look at where your facilities are, would you make an asset, it's a multi-billion-dollar investment in an asset, a manufacturing facility or a data center, whatever that would happen to be, in parts of the world that are unstable? Of course not. Would you do that where there's not a predictable government? Of course not. I mean, basically, so that's what has to change. Now, the question is, where do you go? And then you need stable environments where you have trusted governments that you know they'll be reliable and predictable, that you can make these long-term investments. Now, there's a lot of those locations in the world, by the way, but fundamentally, that's what you need to do. Now, from a government's perspective, I don't really think it's practical to say everything returns to your domicile, whoever you are, U.S., Germany, it doesn't matter, France. That's not practical because the capabilities you need in technology in the world, no one geography has total end-to-end capability to lead. They need to collaborate. They need to partner together to actually get this done.
Sam, it's always a pleasure to have you with us on Wall Street Week. Thank you so much. That's Sam Palmisano. He is the chairman of the Center for Global Enterprise. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Western. We're joined once again by our special contributor here on Wall Street Week. He is Dr. Larry Summers of Harvard. So, Larry, we heard from Jay Powell. We've heard from him the last 3 years at Jackson Hole. You weren't too pleased when he had his framework a couple of years ago. You weren't too pleased about his transitory talk. Did you feel a little better this year?
Look, I think he did what he needed to do. It was clear that inflation is the overwhelming priority. It was clear, despite some earlier confused talk about neutral, that he was under no illusion that monetary policy was in an appropriate place right now. It was clear that whatever the academic arguments about demand shocks versus supply shocks said, the Fed couldn't accept continuing high inflation and had to act until it was clear that that was going away. The remarks were very concise. There wasn't a lot of more academic discussion, but there was a statement of being resolute. So I think that's just right. So I think the Fed is positioned as well as it can be, given the credibility losses and mistakes that there have been, with these remarks to manage things going forward.
The chair never used the word recession. At the same time, he did talk about below-trend growth for an extended period of time, also elevated interest rates for a good time to come. Is he really pointing to a recession? Is he between the lines saying, get ready for it?
I think he also had a reference to the fact that there was going to be pain. He wasn't predicting recession, and after all, even someone who's quite pessimistic about the situation like me is saying that there's a 75% chance of recession in the next 2 years. But he was clearly showing an awareness of the possibility, indeed possibly even the likelihood of recession. And I think that was very important, because saying you're against inflation when there's no price to resisting inflation or bringing down inflation isn't a consequential statement. Today, he prioritized inflation, making clear that he recognized that that prioritization would have short-term adverse consequences that wouldn't be easy, but that by bringing down inflation, ultimately there were going to be more jobs with higher real wages for more people. And that's, after all, what economic policy is all about. It was a big change from the Jay Powell of a couple of years ago, who was speaking about the importance of maximizing employment without an awareness of the issues of sustainability and long-run economic performance. So I was quite pleased with these remarks.
So let's go over to Europe for a moment, because they have their own problems over there. The ECB is indicating further tightening, perhaps. At the same time, they're in for what looks like a substantial energy supply shock, particularly as we get into the winter. Are we properly appraising what is going on in Europe and how bad it could be?
Christine Lagarde's got a much harder job right now than Jay Powell does. She's got the dilemmas of inflation, but she's got a truly massive supply shock with what's happened there with natural gas and electricity prices. She has the set of challenges of monetary union, problematic politics in Italy, very high debts in the European periphery. So they've got a very, very difficult set of balances. And they also have the challenge of a credible currency as the euro moves to and through parity with the dollar. So I think it's going to be a very difficult road for them to walk in Europe. My suspicion would be that they're going to have to raise rates more than is currently priced in, but that's going to come at a time when there's very substantial recessionary forces in Europe. And I'm concerned about what that's going to mean for intra-European politics. And I'm also concerned ultimately, and what I think is probably most important, is how it affects Europe's fortitude in this very difficult world we have with a revanchist Russia and an aggressive China.
Larry, back in the United States, one big development this week was President Biden announcing his plan for relief, at least partial relief, from student debt loads. We heard Jason Furman, somebody you know well, I respect him as well. He had some tweets that were, I think, among other things, said this was pouring gasoline on an inflation fire. What did you make of that policy change by the administration?
I did not support large-scale student debt relief because I thought it was using federal resources to make transfers, hundreds of billions of dollars, and I would have liked those resources put to better use, helping people who were poorer, who were more in need, and who would use the money to invest more in the future of the economy. I think that it does add to demand, which does increase inflationary pressures, but that's something that the Fed should be able to offset. But it will mean more need for the Fed to move rates. And I think it needs to be recognized that this is something that's meaningful relative to all the other things that are going on. It's not the policy I would have preferred, but if this is our biggest mistake, we will be doing very well. And this is several $100 billion over 10 years. What we did in 2021 was several $1 trillion over 1 year. So we just need to keep perspective on the scale of this.
Larry, you have helped set economic policy both at the Treasury and at the White House. Was this the economists talking, or was it the politicians talking? And some people, as you know, are starting to say serious economists are not having enough of a say in this White House.
Look, I'm somebody who always believes that you can't go wrong listening more to economics. I think in response to many of the frustrations going back to the financial crisis, there has been some movement away from relying on economists' advice. I think over time that will tend to lead to mistakes because you'll focus on the direct consequences of things and fail to recognize the indirect consequences. For example, you'll miss the inflationary consequences of protectionism. You'll tend to focus on what's good about spending and not focus on the things that are crowded out. So yeah, I would like to see more influence, but I also think that the economics profession has got to do better in recognizing the kinds of concerns that led to the terrible populism that we've seen in many parts of the country. And we need, as economists, to be understanding rather than just dismissing those problems.
Finally, briefly here at the end, I always love to talk about golf. You're a serious golfer. I try to golf some. In the meantime, we have the Department of Justice reportedly investigating the possibility of an antitrust suit against the PGA Tour, I guess because of Live Golf. What do you make of that?
I don't know anything about the merits, but it's just hard to believe that there isn't a higher priority for the use of taxpayers' money in the antitrust area than protecting Bryson DeChambeau from exploitation. I just find it hard to see why, of all the issues that they could work on, that would be the one they would choose. Again, I have no knowledge of the merits, and certainly civil suits back and forth are part of what happens in situations like this, but I did wonder why this was something the Justice Department was taking on.
Yeah, Bryson DeChambeau looks like he can take care of himself, I must say. Thank you so much, Larry, for being with us once again. That's our special contributor on Wall Street. That's Larry Summers of Harvard. Coming up, the first thing we do is we kill all the lawyers. That, according to Shakespeare's Henry IV. But what if all the lawyers have gone on strike? That's next on Wall Street Week on Bloomberg. Finally, one more thought. Workers of the world unite. That was the rallying cry of Karl Marx and Friedrich Engels in their Communist Manifesto of 1848. And their followers took a pretty good run at it, what with the Soviet Union and all. And at the same time, organized labor grew in Europe and in Britain and in the United States. Even as late as 1979, the noble quest of organized labor was celebrated in an Academy Award for Sally Field, leading a sit-down as Norma Ray. But that was then, and now is different, as Cornell's Alexander Colvin explains, with labor unions losing a fair amount of clout in the United States.
We had, over 20% of workers represented in America by unions. Today, it's below 11% and down to around 6% of the private sector. So unions are much weaker.
The question is whether the tide may be turning once again, as job markets have tightened and big employers like Amazon are facing new organizing attempts. Although CEOs like Andy Jassy insist unions are not the answer.
We happen to think they're better off without a union for a number of reasons, including the fact that, it's much harder when you have a union to have a direct relationship with your manager and to get things done quickly.
With the growing push by unions and high inflation and economic uncertainty comes the prospect, of course, of strikes, whether it's in West Coast ports in the United States.
Obviously, anytime you have a negotiation, it's like the ports, whether it's on the West or East Coast, but in this case on the West Coast, we want to keep a close eye because we know the impacts that if it doesn't go well, what it'll have.
Or at Felixstowe, Britain's largest port, which went on strike just this week.
This is a significant moment in the UK's summer of strike. We're on day 2. It's about 2,000 workers who are disputing their pay. Maersk has already had to reroute 3 vessels.
But it's one thing for stevedores or warehouse workers to stand up to management. You know things are getting truly rough when it's the lawyers who decide to strike, as British barristers did just this week.
Fight is what we trained for. Fight is what we do.
Unhappy with the way their fees are lagging behind runaway inflation, putting at risk a classic source of Western entertainment, the sort of thing depicted in Witness for the prosecution.
The question is, Frau Helm, were you lying then? Are you lying now? Or are you not, in fact, a chronic and habitual liar?
Then again, even as a lawyer, I have to ask myself, if all the lawyers decide not to work, is that an economic headwind or is it a tailwind? That does it for this episode of Wall Street Week. I'm David Weston. See you next week.